Hey everyone, it's Imran from Options Insight, your macro options daily for today. Okay, US stocks drifting a bit lower, and I think that's on anticipation of a more hawkish message from Powell today. He's due to speak at 1:30 Eastern time, and that's kind of keeping a little bit of the lid on markets. You have seen European markets continue to outperform. So you can see on the week, we've got kind of half a standard deviation down moves in US indices, whereas Europe's not really doing a lot at all. On the other hand, we have had an up leg in China, and China's obviously had some pretty heavy news flow recently in terms of, are they lifting COVID? Are they not? Some craziness going on over the weekend, which I'll get into more detail in a bit. But Chinese markets up 5% yesterday, which is a 2 standard deviation move on the day, and that puts them up about 5.5% on the week. Now, reason they're up is because people are thinking that these protests that are going on in China are actually going to accelerate the end of zero COVID, because they're going to realize that they just can't keep this going anymore, right? So that's kind of, I think, the hope that we're seeing out of Chinese equities. But we are still seeing commodities, things like copper and things like oil, still struggling a bit. Although they did bounce yesterday. We had metals up. We had GDX having a great day, up 3%. We had metals up, oil up a little bit after getting sold. So that's just chopping around quite violently. But there is speculation there about OPEC cutting production again in their meeting next week, and that kind of helping oil bounce back from those intraday lows that we saw. Vol-wise, vols have started to recover from the lower levels that they saw before the holiday weekend. That's kind of a seasonal pattern that you tend to get. Markets get a bit quiet into the holidays. Vol gets crushed into that, and then it bounces out of it. And that's kind of what we're seeing across asset. And then finally, natural gas. We've been going on about natural gas vol being ridiculously expensive, and it has found its way lower. It's down about 9 vol points on the week, which is a decent move. It's still only realizing 49. I think there's a ton of room to go still on natural gas. Carry, again, coming in the most positive at around 53%. So there is room for this, but to keep going lower, and I suspect it will. But people are just a bit nervous to sell vol on natural gas right now because the kind of gaps that it can have around news flow regarding what's going on in European gas and electricity markets, what's going on with the weather, things like that. There's a lot of event risk within natural gas, and markets are kind of on edge there, and that's kind of keeping implied vol elevated. But for those of us who are willing to take the other side of that risk, there's some nice carry to be harvested as long as you size yourself sensibly. You don't just risk your entire account for these type of trades. There is some money to be made there in our view, and we are still short that stuff. If we look over at carry for the rest of the assets, you do see a sea of green, but that is slightly flattered by the fact that we did go a bit quiet into the Thanksgiving holidays. So realized vol clearly looking very, very low, in single digits in a lot of places. So I wouldn't really expect that to continue. We probably do see a bounce in realized vol as the week transpires, because we've got Powell speaking today. We've got PCE inflation data out on Thursday, and then we've got non-farm payrolls on Friday. So lots for the market to get its teeth stuck into and potentially move around. In terms of skew, not a lot in US. We are seeing European skew catching a little bit of a bid. Still relatively low, but not as cheap as it was. It definitely feels like in terms of spot prices, upside is a bit limited here with European markets. Even though they're not selling off yet, they've kind of stopped going up. And they have been doing very well lately. So we are starting to see bearish divergences in terms of spot grinding out higher levels, but not on any kind of momentum. And that potentially is bringing out some protection buyers out of the woodwork. And which is why, even though implied vols aren't really bouncing in Europe and they're still, a lot lower than they are in the US, people are thinking, well, if markets roll over, then volatility will catch a bid. So we'll buy the downside, which is why skew's catching a bit of a bid. Outside of that, we're seeing a bit of a bid to oil skew again. 2 vols up on the week, back to 5 vols now for the 25 delta risk reversal. That's a decent amount of skew for oil. It had flipped negative briefly when oil was looking to break higher, but now that oil is kind of testing the downside levels and support levels, we're seeing a bid for that downside skew there in oil. We actually don't mind fading that. We actually think that's quite a good opportunity to fade, just because we do think oil will be relatively well supported from the likes of OPEC. As we know, people are now talking about potential cuts. So OPEC kind of don't really want to see these prices much lower from here. You've obviously got the SPR reserves that may need to be replenished. They're saying now that they're going to wait for $70 before doing that, which is potentially another 10% lower. But the point being is there should be some kind of bid for oil at lower prices. So we don't think it's going to accelerate to the downside necessarily. And a lot of bad news with regards to China and kind of reduction in demand arguably is already priced in. That's what we're thinking. Okay. If we now look at kind of the main sort of news flow, so I've said rotten apple. So what we're talking about here is obviously the big news flow that's catching markets' attention right now, or just catching people's attention right now, is what's going on in China. So for those who don't know, there's a big uprising going on in China. There's been people killed in an apartment block because they couldn't get out of the building because Chinese officials had welded the doors shut because of COVID restrictions. Okay, so people were literally left to die in their homes and couldn't escape from a fire. So that has now erupted into mass protests against the China COVID policies and against Xi himself, people calling for him to step down. And so, that's the civil unrest that we are seeing in China. Now, historically, China, the way they deal with civil unrest is, pretty brutally. So, that's one thing we need to see how they handle it. But markets, whilst they did initially sell off, they have recovered. And they've recovered because there seems to be speculation that China may end up softening their stance. And the reason here is because you've got a state-sponsored publication called the Beijing News, which are alluding to the idea that COVID is not a whole lot worse than just a bad cold based on people's experiences with the disease. And then at the same time, you've got health authorities appearing to be more in a rush to get elderly people vaccinated than they've been saying before. So they are just a few little hints there that rather than just crack down and be especially militant with the population that is getting more and more disillusioned and more upset, there may be some relenting here from the officials. Okay. Now, another interesting development is the involvement of Apple, the US company. Okay. So, they've been said to help the CCP against protesters by restricting airdrops and hindering communications between protesters. So there's already a lot of kind of censorship, and there's restrictions on what Chinese civilians can do with regards to the internet access and things like that. So the way a lot of these protesters got organized is by using that airdrop functionality that you have on your iPhones. Funnily enough, with Apple doing that and seizing these people's ability to do that, all of a sudden COVID restrictions on their iPhone plant that have also been in the press because there were protests around that, suddenly those restrictions are getting lifted. So that smells a little bit fishy, and that kind of shows you some of the motivations maybe as to why Apple are doing what they're doing. Apple have also been talking about banning Twitter from the App Store, and that sparked criticism from US congressmen because Elon Musk, obviously taking over Twitter, is now all talking about free speech and commitment to free speech and things like that. And you now got Google and Apple kind of saying that they might not allow Twitter on their App Store. So bit of bad press flying around for Apple. The stock doesn't really seem to be liking it. You can see this underperformance in Apple relative to the S&P recently, and that's fairly rare, right? We see how well those two things have tracked each other all year, and then usually the divergence comes from Apple outperforming the S&P, not the other way around. Suddenly we're seeing Apple recently take a bit of a nosedive, and that's underperforming the S&P. Meanwhile, if you look at Twitter stock, it's flying, right? Since Elon took over, that thing has just been going one direction up. So clearly the market, if the market is any kind of voting mechanism, people seem to think that whatever Elon's doing may well be good for Twitter long term. And then the last chart here on the right is just showing that when the initial news came out about the protests and the civil unrest in China, you had all these Chinese indices, Chinese ETFs, things like that selling off, along with Apple, which is in the blue. And whilst those have ripped higher now on this news that maybe officials in China are going to end up softening, well, Apple stock is still on its knees and has not bounced alongside those Chinese markets. So quite interesting to see that divergence in Apple stock. And the reality is Apple is still the largest company, above 2 trillion market cap. And if Apple does go lower, it's going to be hard for the market to go higher, right? So from a US market perspective, that last general standing, if that's going to start to crack, then that may not be good for just broader market sentiment and for levels on the S&P, basically. So something to be aware of and something to be careful about. Okay, moving on to oil. So we take a look at oil. It's almost flat on the year. So that's quite surprising, right? Brent crude oil here, I've got the chart here from Saxo. We look at where it was in January. Well, intraday, it was, when it was touching close to 80, that was like only a couple of dollars away from where it started the year. So really quite a massive pullback in oil on the back of this news and these lockdowns coming back in China and the COVID cases exploding. People really pricing in oil a lot of demand destruction in the short term. Now, if you look at positioning in oil, we've got Brent and WTI crude oil positioning here in terms of speculative positioning. There was a decent move down in that as well as we broke. So this yellow line kind of shows you the net positioning, and it kind of did impulse lower, and that was the biggest 2-week reduction that we've seen in positioning since September 2020. So that was interesting to see, and maybe that's your kind of indicator of a bit of a flush out there, a final capitulation in some of these oil longs, and maybe stronger hands now have come in and prevail. Now prices have since rebounded in oil because there's speculation that OPEC are going to cut next week. We know that they don't really like levels down here in terms of price. When they were around here previously, that was when they came in with their 2 million barrel production cut, and prices went higher. So the fact that prices are kind of retesting these sort of levels, maybe there's some truth to it. However, the meeting is not an in-person meeting. It's going to be done over Zoom. So again, people speculating maybe that they're not actually going to change their policy that much. And then you've also got the whole thing going on with the Russian price caps. So maybe they're going to wait and see what that does to the market and then come out with something at a later meeting. So a lot up in the air, but the oil price is really winging about and moving quite a lot. If we look at the oil dashboard, we look at our volatility dashboard on oil, what do we see? Clearly oil prices are at the bottom Bollinger Band or not far from there. So for choice, picking up some oil exposure down here, if you haven't already got some, would make sense. We have been long, obviously, via some January calls that we're running. So we have restructured that trade now, just because the contango in the oil curve, it was in backwardation, but now it's gone into contango. So generally, when the curve's in contango, you're a little bit less short-term bullish because it's giving you a sign that the market's not as tight as it was. So that makes me think, whilst I've got these calls that expire in January on USO, that's starting to now get quite short-dated. We're only a few weeks out from December, and then there'll just be 1 month options. Plus, you've got the Christmas period. So unless we really needed the move to start happening and look like it was going to break out to the upside to really want to hold on to those Jans. So from my perspective, it made sense to roll out my exposure. So looking at how you would do that, would you just roll straight into longer calls? Probably not. The reason I wouldn't roll into longer dated calls is just because you look at the term structure, you can see longer dated volatility is quite elevated in the mid to high 40s, right? So if you're rolling out from January further out, you're actually rolling up to a higher implied volatility, which isn't generally particularly attractive, right? On top of that, do we like owning volatility too much in oil right now? Well, it's certainly not realizing. So the volatility carry right now is around 18 positive, which is in the 84th percentile, which is saying that realized vol is around 30, implieds are around 45. So just owning outright optionality in oil doesn't feel like a no-brainer right now, okay? So we're kind of thinking we probably want to move towards something longer dated that gives us much more time for the move to play out, and something that carries relatively well and doesn't bleed too fast. So we've landed on a call spread collar. We're looking at the skew. The skew's back to 5 vols, as I mentioned previously. So selling some downside puts to get some premium, using that premium to buy some call spreads allows us to carry that position into April, not have a theta bleed to worry about, take advantage of the fact that the puts are relatively well elevated and the vol is relatively high. So it's a vol sale when you buy a call spread and you sell a put. So that's called a call spread collar. It's a net vol sale. We think vol does have room to kind of continue to go down, or at least not carry well, and maybe into the holidays, into the end of December, that vol is going to continue to go lower. And had we owned January call options, they would have just bled their premium and we make no money out of it. So we've got rid of those January options. We've recouped any premium we could from them, and then we entered a new trade. The actual trade that I've done is, all right, that's it for today. Good to be back. Hope you found that one useful. It was a pretty comprehensive one. And I'll catch you all you guys tomorrow. Thanks a lot.